It's 9:31 a.m. The market has been open for 60 seconds. A trader in Midtown Manhattan is already on his third phone call, his voice completely flat, telling a client to stay calm while internally calculating whether he still has a job by Friday. Across the floor, someone is making a fortune. That's the thing nobody tells you about a market crash. It isn't a single experience. It's a dozen completely different stories happening in the same building, at the same moment, with the same data on the screen, and almost none of them end the way you'd expect. So let's go through them, one by one. Start with the retail broker, the guy whose job, on a normal day, is to smile through the phone and gently steer nervous clients toward patience and diversification. He has talking points, he has scripts. Ironically, he has scripts, but on crash day, those scripts become useless, because the client calling him at 9:45 a.m. isn't nervous. He's been watching CNBC since 6 a.m. He's seen the futures down 3%, and he has one question: get me out. The broker's job, technically, is to execute the trade. His job, emotionally, is to talk the client down, and his job, financially, is not to lose the account. These three things are in direct conflict with each other in real time. Every call is a negotiation. Every call is a small crisis inside the big one. And here's the uncomfortable part: if he talks the client out of selling at the bottom, and the market recovers, he's a hero. If he fails to talk them out of it, and the market recovers, the client made the wrong call. But if the market keeps falling, and the broker convinced them to hold, that relationship is over. And so might be his career. He is gambling with someone else's money and his own livelihood simultaneously, with no real information advantage over the person on the other end of the phone. Now go upstairs. The portfolio manager. This is someone who actually runs the money, not talks about it, runs it. And on a crash day, she's working with a constraint most people don't realize exists. She can't just sell everything. If she manages a $5 billion fund, she can't dump her positions in a morning without becoming the reason the price drops further. The act of selling accelerates the crash for everyone else, including herself. So she's doing something counterintuitive. She's selling slowly, strategically, quietly. She's managing the exit the way you'd manage a theater evacuation, because if everyone rushes the door at once, people get hurt. Meanwhile, she's on calls with her analysts, who are updating models that were built for a world that no longer exists as of this morning. They're not working with certainty, they're working with best guesses dressed up in spreadsheets. This is the part that would unsettle most people. The professionals don't know either. They're just more comfortable not knowing. Now go to the other side of the building. The short seller. This person has been wrong for 11 months. She bet against the market, and the market went up, and she lost money, and people at cocktail parties called her a pessimist. She sat through meetings where her thesis got picked apart. She renewed her conviction anyway. Okay, today, she is right, and being right feels almost nothing like she expected, because there's no celebration. The position is moving in her direction at a speed that creates its own problems. Do you close now and take the profit? Do you let it run? If you close too early, you leave money on the table. If you hold too long, the government might intervene, the Fed might step in, the rules might change, and yes, the rules have changed mid-crash before. The short seller's nightmare isn't being wrong, it's being right at the wrong speed. She's eating lunch at her desk. She hasn't called anyone back in 4 hours. Now go further down the chain. The risk manager. His job is to exist in the background until the moment he becomes the most important person in the room. That moment is now. He's the one pulling up the firm's exposure across every asset class, trying to figure out whether what's happening in equities is going to bleed into the credit market, into currencies, into commodities. He's looking for contagion. He's trying to answer one question that sounds simple and isn't. How bad can this actually get? And here's where the math gets genuinely uncomfortable. Most risk models are built on historical data. They measure how bad things have been. But crashes, by definition, tend to do something unprecedented. The thing the model didn't account for. The correlation that wasn't supposed to exist. The asset class that was meant to be a hedge and isn't. Risk management in a crash is often the discovery that your protection didn't protect you in the way you thought it would. The safety net has a hole in the shape of today's crisis. He will not sleep tonight. Now go to the absolute bottom of the hierarchy. The junior analyst, 23 years old, has been at the firm for 7 months, has never experienced this. He's doing the same thing he does every day, pulling data, updating models, sending summaries up the chain, except today. Every number he types feels like it might be wrong before he finishes typing it. The market is moving faster than his spreadsheet refreshes. He sends a model to his director. His director sends it back with 2 words, redo this. He doesn't know if he's being tested, if he made an error, or if the world has simply changed in the last 40 minutes. He redoes it. He sends it again. He waits. No one tells him anything. He finds out what's happening the same way you do. He refreshes Bloomberg. He reads the headlines. Okay, he is sitting inside one of the most powerful financial institutions in the world, during one of the most significant market events of the year, and he is functionally an outside observer. That's the part nobody puts in the brochure. Now zoom out. Every single one of these people is reacting to the same event, the same red numbers, the same falling prices, but their incentives are completely different. Their time horizons are different. Their definitions of disaster are different, and their actual power to do anything about it is different. The broker needs to save the relationship. The portfolio manager needs to preserve the fund. The short seller needs to not get greedy. The risk manager needs to contain the damage. And the junior analyst needs to not get fired for something that isn't his fault. None of them are thinking about what's right for the broader market. They're thinking about what's right for their specific position in the next 4 hours.